Hey, how you doing? And welcome back to another episode of The Rules of Investing, a podcast that gets inside the minds of leading investors, economists and industry experts, brought to you by Livewire Markets. I'm Ali Selby, and in the last episode you heard from Janice Henderson's Josh Cummings, who outlined how investors can find a winning long-term stock, the red flags investors should look out for when investing in global companies, and why he believes AI is going to be far bigger than we could ever conceive of today. This week, it's all about quantitative investing and ETFs. For context, I recently wrote a few articles on the funds that have consistently outperformed the index over the last 5 and 10 years. Here at Livewire, we call it batting average. It's a cricket and baseball term used to calculate a player's ability to score runs. Interestingly, Macquarie was one of the few firms that saw its funds deliver batting averages of 100 in the pieces, meaning they beat the benchmark 100% of the time. It did this with its quantitative funds, which remove the behavioural biases that we all face when investing and focus on what the data is saying instead. So, for a beginner's guide to quantitative investing, as well as some of the major trends in ETFs today, we're joined by Blair, the head of Macquarie Asset Management's ETF strategy in Australia. If you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. Not a Livewire subscriber yet? What are you doing? Just head on over to livewiremarkets.com. It's free, easy to register, and you'll gain access to insights from leading investment minds in the country. Okay, let's get on with the show. Thank you so much for joining us today on The Rules of Investing, Blair. That was quite the mouthful. Thank you for sitting through that.
No, that was great. Thank you, Ali.
Very excited to have you here today. I feel like not a lot of investors know that much about quantitative investing, so excited for a little beginner's guide today. To start off, why this systematic or quantitative approach over fundamental stock picking?
Yeah, let's put a caveat up first. I am not the PhD or rocket scientist who is behind the quantitative strategies. Obviously, as you said, I'm on the ETF side, and again, the context here is that we've released some ETFs that are built around this quantitative or systematic strategy. So that's where we're coming from. But I think it's no question, it's worthwhile spending a little bit of time on the differences between fundamental, and you can even put passive in here if you want, but fundamental and systematic or quantitative, because they really do stem from the same place. And that is, you want to generate alpha, you want to try to beat the market. That is what active management's all about. I think everyone's pretty happy with that style of investing, but they diverge pretty quickly from there. So if you think about a fundamental, and I know you have a lot of portfolio managers, on this show, essentially they're an expert of something in some area. No one's going to be an expert of everything. No one's going to be, if you think about how, sell side research works, there is an industrials analyst, or a telecommunications analyst in that space. Like they have to be niche, and they're niche because they're awesome at that particular style of analysis of those companies. And the big difference is that quantitative is much more high level, but we're using big data essentially to look at all companies at the same time. So you're getting a very different take on what is the same structure using, if you think about what fundamental data is, it's just PEs or looking at understanding balance sheets. So, that's thinking about how a fundamental analyst would go about their day, but it probably isn't going and meeting the companies. It probably isn't doing 500 meetings a year and understanding and staring at the whites of the eyes of the CEO. It's looking at the data at a much higher level and then making a call on a particular position, in the case of a stock, and whether that stock should be, in the case of how most systematic strategies work, either an overweight or an underweight. So, which is again quite different to how fundamental work. They're kind of all in on a stock, or they're not. They're making a call. So we like this position because of X, Y, and Z, and we're going to buy it. We hold it in our portfolio. Where because most quantitative managers are index aware, there might be underweights on index. So it might be holding less of, for Australia, for example, the banks for some reason, based on whatever the data is sort of indicating. So you're getting very different outcomes on that. So if you are slightly overweight or slightly underweight compared to taking bigger positions, what it usually means is you can be a bit more specific around the outcomes or what your expectations are for alpha. You're not getting those big swings where if you were, as a fundamental fund, all allocated to some of the Mag 7 and you had a great couple of years, you'd had huge amounts of alpha, but then you'll have periods where you're getting significant underperformance as well, where this is much more around eking out smaller gains, but those smaller gains being really, really consistent over long periods of time, which is going back to that point around your batting averages, and that's where obviously, with the existing unlisted funds we've have done really well. So I think there's definitely differences, but they're all still pointing the same direction, which is generating alpha.
When I first started in the finance journalism beat, I became really obsessed with behavioural economics, I guess just basically because it's like why we make such stupid decisions with our money. Do you feel like this removes all those kind of behavioural biases that we face every day?
I think hopefully everyone read Kahneman's Thinking Fast and Slow. I hope you have. If you haven't, it's like an amazing book. It's obviously he's the father of behavioural economics. That is the point. You're probably aware, like even if you know that you've got a bias, you just can't do anything about it. Like there's research on the back of that. You just can't solve that problem because it's so ingrained in human nature that whether it's all the generic pretty ones that everyone knows about, anchoring, loss aversion, the lottery effect, in terms of having a big bet on something that can have a huge outsized return, but obviously on the other side as well. So the way that systematic is exactly what you said, is taking away the human interaction, utilizing a model that's been built with signals to then, again, generate returns, again, in a longer term way. And in a lot of these signals are built on, to the exact points you're mentioning, these behavioural biases that we can't avoid as best we want to. Again, fundamental manager might have some really good system in place to try to avoid those. It's just built in. We're all humans, and we can't help that.
Do you have any examples of that? Of those signals that avoid those behavioural biases? Yeah,
so it's much more around, if you think about how most how most quantitative managers run their system, it is taking the human out of the system completely.
Right.
So as much as Macquarie will have oversight from a portfolio manager, and they're not changing a position where if the model is indicating that we're going to go overweight a couple of particular stocks, the manager doesn't go, I don't actually like those, I'm going to pull that back. That is what it's built on. But a lot of the signals they flow down from those. Again, we'll use the lottery effect again. So if you look at the lottery effect, that is picking, many people pick small cap stocks. There is a huge potential outsized return. It's similar to buying a lottery ticket. You buy one lottery ticket, you may win, multi-millions of dollars, but you're also going to lose most of it. Like inevitably, that's what's going to happen for 99% of the people who buy lottery tickets. The same thing in stock investing. If you sort of dig down to that, what are those sort of metrics that are built under those type of biases? Well, one of them is something like price volatility, for example, the volatility of a stock. If you see it, going way up really high and then coming back down, you think maybe if I caught that spike, I could have made a lot of money here. So using data, you can have a look and say, okay, well, we want to then nullify that volatility and have a much more smoother return. What is the data that's going to help us indicate that? How do we build that into a signal? And that can then, as you start to compound multiple signals into that, you're getting a much better opportunity to outperform. So, those, talk about lottery effect again. Like I'm guilty of that. I'm sure you are. Like it's just inherent in who we are. I don't necessarily think that many, fundamental portfolio managers are of that, but we as probably, in your personal account, probably has a few bets in there that 100%. That probably aren't going to come off, but you'll give it a shot.
Yeah, and some have paid off and some haven't. Before you talked about removing the human from the process, do we even need PMs for these quant funds then? Particularly as we move into a higher tech world with generative AI, do we even need PMs for these kind of quant funds?
Look, I think where humans still are integral is we have a huge research team that is building and helping build the signals, thinking about what other data sources we can access, what are the ways that we can either tweaking the existing signals we've got or researching new signals to put into this data pool of what we can build. So that's really important. So yes, definitely. There's no AI that's doing that right now. I'm not saying that's not going to happen in the future, but certainly not in the near future. Where there is need for human oversight, and you can make some examples here, is COVID's a great example where the model in COVID might look at airline stocks, for example, and go, they're a screaming buy, right? They have huge amounts of value based on all the signals we've got, but it doesn't know that no one in the world is going to fly. it can't figure that out. So you need human oversight in some really specific scenarios that then a human can step in and say, well, the model obviously can't see the contextualization of what's happening, but they're reasonably unique. So most of the time there is a lack of human interaction on purpose. But we need to make sure that there's some sort of oversight, just to make sure that the model's not sending us down a path that it shouldn't be going. As
I mentioned in the intro, I feel like not a lot of people know that much about quant investing. Are there any common misconceptions that you often hear about quant investing or systematic investing? Particularly, I feel like I always hear the black box.
Yeah. I think the reason that the black box is such a easy way people think it is because it's very hard to understand what's happening behind the scenes. And again, we didn't go to this point, but fundamental analysis is something that everyone can do this. Like you can do it, I can do it. You can look and obviously varying levels of skill. I understand that, but everyone can do it to a certain degree. Whether you understand a balance sheet or not, whether you understand a profit and loss statement. But it is the old sort of Peter Lynch Buffett, go and touch and feel something. You're making a fundamental call if you like that product or store or whatever it is. And then you can make it AI, you've used ChatGPT and you're like, I like this, I think it's this huge future. You're making a fundamental call that that's what's going to happen and you can invest on the back of it. The problem for systematic is like there is no way you can DIY systematic. Like it doesn't work. Like no one can do this at home.
They can't build their own models in Excel or anything like that.
Well, look, I certainly can't. Let's make that very clear. Like as I said, you're talking about people who are quantitative backgrounds and PhDs and obviously very smart people, not including myself, who are building these signals and have huge reams of data that also have huge reams of history. So they're building on existing history. So what's difficult about quantitative investing today is if you just went, okay, I'm going to go build one. I'm going to go build a quant fund manager. You have no history. You have to access huge amounts of data. You need to build a signal pool, and you need huge amounts of compute, right? You need the power to do this. So it's probably why you're not seeing a huge amount of investors in the come into the quant space. Those who have Macquarie been around for 30 years, again, we're a fund manager, so we're letting other people come in. The other area of quant that you probably find is Renaissance, Jim Simons, the Medallion Fund. That is quant. That is all that is. But that's instead of them selling it to someone else, it's all their own money. So it is a bit of an exclusive club to institutions for from a fund manager's perspective or internal money. And part of that is because even really smart asset allocators can't. We can dig beneath the surface a couple of layers, but once it gets really deep, and you hear our sort of quantitative guys talk about, doing 500 simulations of different universes of how the market could have gone and how they learned from that. Like we're getting into some stuff that is, again, above my head for sure. So, but I think that black box thing is a bit of an issue for people. So what we obviously try to do is open that up as best we can and say, let's give you as much color as is going to help you understand what you're trying to invest in. I think the second part is people have associated quant with high frequency trading now for a little while, which if you're a high frequency trader, you're in the market, you're buying and selling stocks really quickly. It's obviously not what quant does. Quant's around, usually buy and holds, but making calls on the specific stock. So it's not trading, obviously in the name, high frequency trading, compared to actually, being a fund manager. So I think there's a couple of misconceptions around that. And the big one, I guess, again, versus and we've seen it recently again in some of the fund managers, there's no real big key man risk. There's no rock star, superstar fund manager that either catches a really good tailwind for a while and does really well and then doesn't do so well and then everyone sort of goes in and comes back out. Like that's not the case. It's about consistency for these guys. It's about building a really robust model that can last for a long time and has a really good history and track record. So the risk of that happening is negated really significantly. So that's I think there's some real positives about it, but it is breaking down the barriers of what is quant and is it just something I can't understand.
Let's break down those barriers a little bit more, open up that black box. Macquarie has a large language model with over 1,000 alpha signals. The process currently uses around 60 to 70 of these signals to select the best stock positions and organise the portfolio. What have been working in 2024?
Yeah, so I think that's it's interesting. So if you think about how we do it as a systematic, we're taking in around 100 million data points a week. So this goes back to that point around no DIY. Like, obviously no human can look at that and make any sense out of that because it's just too much information. From that, we have built a signal pool of 1,000, as you said. So that is a huge range of signals that
I can't even believe there's 1,000.
There's 1,000.
signals.
Now, to your point though, we're not using all those signals at once because the system has been optimized to build that we can use sort of 60 to 70 of those, as you also mentioned, that are giving us the best alpha outcomes. So you don't need to use them. So there might be iterations in that 1,000 pool that of a similar type of signal. And again, just to quantify, these is based on like certain parts of the data, like again, fundamental data that everyone knows and understands completely. And how does that indicate that a stock's going to potentially outperform the index versus its benchmark? So if you think about, I wouldn't say there's any hero signals that are, this is the signal that has absolutely killed it this year, and then we need to back that in, because it's not, as everyone always says, past performance doesn't indicate future performance, and that's part of what we do. Is that pool of signals is always constantly moving and shifting. To actually answer your question though, because that was a bit of a roundabout, no question, momentum last year was the big winner.
I feel like this year too, though. It
certainly, if you as a run rate, momentum has really been where there has been significant alpha being made. So if you think about where the signal pool is, a lot of those momentum style signals, whether that's based on a bunch of different styles of understanding what price appreciation or EPS gains or whatever those sorts of things that are coming out, or an analyst upgrade, there's a whole range of ways you can get access to that data, whether it's just fundamental or non-correlated, or to your point on the large language models, we utilize that sort of data to understand the tone of an AGM talk from a CEO. So you get a lot of that momentum built in. So they have certainly worked, but again, that doesn't mean that it's going to work going forward. So you need to have the ability for a model to say, okay, momentum's great, but it might be a growth regime going forward. It might turn into a value regime. And if you're tied to one of those, you are going to be in trouble, obviously, if that regime shifts. So the great part about these sort of, again, having that longevity in this space and being around for 30 years with this quant model, it can move with those regimes. So the model is built to sort of indicate as that there's obviously not a line in the sand. It goes momentum one day, growth the next day. But as it shifts into that, you generally will see the model move with it. And those signals, as I said, that pool will slightly change around what those are. So again, doesn't necessarily indicate that momentums have been a really good driver so far, but that doesn't mean it's going to be, again, momentum, or it's going to be quality, or it's going to be value going forward. But that's the power of having a really good model, because you have the ability to play in all those spaces.
We talked a lot about the difference between fundamental and quant investing today. One of the most famous investors in the world, Warren Buffett, he says his favourite holding time is forever. How often are you turning over the stocks in this kind of quant strategy?
Look, if you go against a passive index, it's higher. We obviously have benchmarks. So it's generally around 40% a year. The idea with this model isn't to, though, there's a big event and Nvidia's just reported we're going to swing and go a different direction. These are much more long term. So as much as we do rebalance the model sort of once a month, you will find that signal pool, as you mentioned, those signal pools won't change significantly. So, and that means that and we'll try to pick an example. This is not specific, and I'm not making one up. But we used it before. If you're overweight banks, and that's been a great trade for people this year, and we are seeing to indicate through the data that is coming to the end, what we might do is slightly underweight the banks. So we're still going to hold the banks in many of these portfolios, but if their index weight, I don't actually know on top of my head what the index weight of CBA is, but if it's 5%, we might only hold 4%. And there's still the ability to generate alpha for us by that versus an index. So it's just a very different outcome. Whereas if you're a fundamental player, thinking Warren Buffett, but he may either hold through that cycle or they may just cut that position completely and be out of those positions and then move on to something else because they've obviously got finite ability to allocate capital. So it's, again, a different style of investing of taking smaller bets above and below the index that generates, again, a more specific target of what we think we can generate from an alpha perspective.
Are there any signals that you think are really important for long-term alpha generation?
Again, we don't have any of these hero signals. What's sort of certainly worked over the period of time is those quality style signals where you've seen, and we've seen that in some of the factor ETFs that are out there that have sort of just gravitated towards that one style of quality. If you dig beneath the hood of those, all they're looking at is 3 metrics of style of quality, where we've got a huge amount of more depth around quality. But what you might find is that if you overlay a quality style signal with a value style signal, you actually get better performance because it starts to mute those bigger swings in those periods of time. So look, there's just nothing to say if you're not loaded up on quality signals, if you're not loaded up on growth signals, you can't make money, because that's not how these sort of styles of investing works. It is about having signals that can work across all those styles of investing, because yes, we've been in a really strong growth regime, momentum regime. That doesn't mean it's going to happen going forward. And there's another bias, right? It's a recency bias. People allocate towards what's happening recently, and this is exactly what we're trying to work out and push out of the investing style, because if you do have that problem, you will just go whatever's winning previously, and that's, inevitably at some point that's not going to work.
I want to talk about the funds now. They aim to deliver around 1% alpha a year, which doesn't sound like much. Why is that 1% attractive in your view?
So these are some new ETFs we brought out, and part of it, the reason it's attractive, was one file when we talked about the misconceptions of quantitative. It is, the great thing about ETFs is they have democratized investing. So what is previously quantitative was essentially institutional only. Macquarie runs around 65 billion in quantitative strategies. 60 billion of that is institutional. So predominantly institutional. Can be open to anyone. So that, I think that's what's great about ETFs is you do get true democratization. Everyone can access the same strategy. So what we thought was, okay, we can bring this to the table. And before coming to Macquarie, my background was in passive ETFs, which have solved a lot of problems for a lot of people. But what we continually heard was many investors weren't necessarily passive acolytes. They weren't like, passive's the only way. I just need passive, especially at the core of a portfolio. So they were really open to saying, heck, the core of the portfolio is getting larger in terms of what my allocation is. But the problem I'm trying to solve there is a cost problem, which is great for ETFs, which are low cost. They solve that problem for you. So we sort of said, okay, well, can we generate an ETF that is low cost but also is going to outperform? It doesn't need to outperform by a huge amount, and talked about that 1%. So, why does that matter? Is if we can be consistent, and again, this is what we talked about around quantitative investing. If you can be consistent and you can continually deliver 1% a year, yes, 1 year is not going to be a huge difference. But if you start to say 10 years or 20 years, that is becoming a significant difference. And what is it due to? It's due to compounding. So the way that we built these is we're going to give you a really low fee, which is very similar to passive. So that, if cost is a problem for you, or cost is something that you're conscious of, that's going to work. And we're going to then align ourselves with you as an investor and only really charge a performance fee. So if we outperform, if we do win, we obviously take part of those winnings. If we don't, then you're obviously only paying those really low passive fees. So what the generation is let's give investors options to have a potentially consistent return at the core of their portfolio, not have to pay really high fees, which you generally see in active investing. So it's that sort of, what kind of the best of both worlds. It is the best of both worlds. We're passive, where you're getting low cost, but also getting the ability to generate alpha. And look, the response has been really good so far, but we think we're early days. And we think this is a real opportunity for, hopefully we've broken down some barriers today, the beginner's guide of quantitative, but for investors to sort of understand different ways to invest other than just passive or just fundamental.
Okay, at the beginning I talked about the batting average articles that I wrote. looking at the most consistent outperformers over 5 and 10 years. Macquarie shot the lights out over the past decade with a lot of 100% batting average, but it was a little bit different over 5 years. Although it was still high, the batting average was in the 80s and 90s. It wasn't 100%. What happened there?
So just to be really clear, these are funds that we've run for 20 years, so they're not these particular ETFs, but it's exactly the same strategy in terms of the same model, right? Because these are the systematic model. So again, a great thing, it's replicable across a huge spectrum. So what you're getting as an investor in an ETF, investor in these unlisted funds, or to a certain degree an investor in some of the institutional funds, is a very similar model that's getting top down, looking at these stocks. So these, look, obviously it was great to see that the analysis called 100% for the longer periods. There's no question though, on shorter periods there's going to be aberration. Like this is not a magic pudding. Like we're not just, alpha just doesn't come out of the sky for this. Like there is a lot of obviously.
Sorry, I should say, so over the 10-year period, it's rolling 3-year periods, and over the 5-year tracking area or tracking period, it was rolling 1-year periods.
Yeah, so it was great. Look, it was, to your point, great to see over that longer period, the rolling 3-year, that it was that 100%. So that is essentially indicating that those funds have been outperforming, and there was obviously a long period of time, have outperformed every time of that 3-year period. Where over the rolling 1-year period, as we know, the last 5 years, there's been some pretty wild ride.
Volatility.
Yeah, so as we know, those periods are going to be difficult, and we just mentioned that we talked about the COVID story before around having some manager oversight. It can be more difficult for anyone. So as we would expect, we expect to see that model play out over longer periods, which is the whole point about consistency, about being allocated for a long period of time. Over shorter periods, no question that we do expect to see some, periods of whether it's underperformance or inline performance, and that's always going to be the case because, again, we don't have any biases around sectors or factors, or there's going to be periods where we maybe aren't catching that huge run that's getting caught by 7 stocks, and if you're not allocated fully or overweight, you're going to miss out. Or that huge rebound from COVID, if you didn't have all those holdings, you're going to miss out. So there's going to be periods for that, but it was great to see the fact that those over those longer periods, which is what we're building this whole business for, can match those numbers. So it was great.
I should say that like a batting average of over 80 or in the 90s is still incredible. Like anything over 50 is incredible. So the funds still have mostly outperformed and consistently outperformed at that as well. Let's talk about ETFs in general now. ETF popularity has completely exploded in recent years. Do you see that continuing?
Sincerely hope so. No, I do. And I think the reason why is it doesn't matter what style of investor you are, or where you invest from, whether it's through an advisor, self-directed. ETFs are solving a problem for you, and they're solving a problem in multiple different ways. That could be low cost, which is certainly beneficial for consumers. That could be, now with active ETFs coming, much more opportunity. That could be getting access to a fund manager you couldn't get access to before. So no one wants to fill out a paper application form and send it to a manager and wait and hear back. Like no one wants to do that. ETFs are much better as a wrapper of a solution, and just the breadth of opportunity too. So we're well over 300 now. It could be over 350, I think, in ETFs in Australia. We're talking about in the US about 8,000. Like your opportunity set is significant in terms of if you have an idea or you have a concept of how you want to invest. There's a saying in the US, there's an ETF for that. And that's what's going to happen here in Australia too. There is going to be an ETF for any way you want to do that. And whether that's, again, broad-based passive, thematic investing, active investing, I think that's only going to continue. And you're going to get more opportunity as an investor, which is only a good thing to allocate the ways you want to invest. And as more people come into the system, the better it is for the liquidity of the system, the better it is for, other style managers to come in and give you more opportunity. So I do think that is going to continue, and the numbers obviously showing that the growth numbers of recently in Australia are huge, and we really are still small. We're over 200 billion. The US is 8 trillion.
Oh wow!
So and there is some significant differences there. They've got some pretty solid tax tailwinds for ETFs versus mutual funds, as we call managed funds here. So that we don't have those in Australia, but I guess think that the actual structure of the products, that's what it is. And I'm obviously an ETF guy, I get that, but and I'm talking my own book here a little bit, but it just, as a structure that makes sense. And it seems to be working really well for investors.
As you mentioned, there's quite a few active fund managers who are launching active ETFs, so moving away from LICs or managed funds to offer active ETFs instead. What are you seeing in terms of flows? Like, is the money actually going to those products?
I think there's a couple of interesting things happening here from active managers. What a lot of active managers have done, and something we have done as well, is opening the door to more investors or more investors to be able to come into the funds that they've been running for a long time. So, for example, we had 3 funds that we released back in November of 23, and those funds have been around for 20 years in the unlisted format or managed funds. So it's really saying to investors, we know that you want to access our funds in different ways. ETFs is something that you like to invest through. Great, here you go. You can now invest in some existing strategies. So you'll still see that. You'll see a range of active managers bringing existing strategies to the market. And that's all well and good. I don't think that really pushes the market though. It doesn't. There's no huge amounts of innovation there. Like ETFs aren't innovative anymore. They've been around for 30 years. So what I think is going to happen is active managers need to put their ETF hat on. And this is an example of these quantitative ones, and say we need to bring out ETFs in an active sense that suit the ETF market, that aren't, it's no problem having access to existing strategies, that still works, and that there's benefits to that. But you also got to think about different ways you can bring, because what are the ETFs synonymous with? They're synonymous with passive. That's kind of what's where it's gone down. So active managers need to understand that and think, well, what other ways can we bring our skill, our advantage in an ETF that isn't just plonking something else down in the market and hoping for the best. That's not the way it's going to go forward. So I think flows wise, what you're generally going to see is allocations to those active managers who are understanding that cost is an issue for ETFs, or they're a lower cost, and being more creative around how they want to deliver that to investors as well. So, but there's huge growth coming in that space. I think Macquarie, for example, been in the fund management space for a very, very long time. We only got to the market back in 23. So there's a lot more to come. So I think, again, only benefits investors. I probably understand people saying, more choice isn't necessarily great if you think about it in the lens of Netflix and you're trying to figure out what you want to watch. But I think as an investor, as long as you've got reasonable tools to look under the hood of these ETFs, and whether that's through an advisor or that's through some of the investment platforms, then the choice is a beneficial thing.
You talked about the market in the US, $8 trillion. Is there any innovation happening over there that you think we should really be implementing here?
I think they have. It is so big in the US, and it's so well used. It's the outside of single stocks now. Mutual funds they're not dying, but pretty close to dying. Like in terms of the ability to access through the exchange. We know over there that, which we don't have in Australia, brokerage is essentially free. So there's no barrier to entry at all. And I mentioned it before, in the US there is, for investors, reasonably large capital gains benefits versus a mutual fund versus an ETF. So you benefit out of that. So what's essentially happened is you had massive proliferation of passive providers, and there's obviously the big 3 in the US, BlackRock, State Street and Vanguard. And they've got, their product sets are huge, but what you found in the US, which we don't really have in Australia, is a lot more smaller players. So there's a really, really long tail of smaller players who can still be really successful. Obviously, the market.
ETF product issuers, you mean?
Yeah, ETF product issuers who can be really successful because the market is so large too. So you talk about $8 trillion. It's very hard to do that in Australia, where if you're 250 billion, even if you got 1%, it's not going to really solve huge amounts of problems for you. But if you're 1% in the US, that's massive. If 0.5% of the whole market, that's huge. So I think what we're generally seeing is a push down a path of a bunch of different styles of investing. Obviously a lot of leverage, a lot of access to areas that another example. So the options market in the US is obviously much bigger than the Australian one. There's a huge options market over ETFs. It is massive. But again, because you're playing on really ultra liquid, big style of investing. So there's some nuances in the US that probably don't lead easily down to Australia. But there's a lot that do. And then what you'll see with those bigger players, those big three I mentioned before, they understand what's happening in the US. How does it work from an Australian lens? And they can help bring that stuff down to Australia as well.
Okay. Before you talked about, I guess, the possible death of mutual funds, which is our managed funds. We have seen quite a lot of consolidation in the Australian funds management market. Do you feel like we're going to see continued consolidation and maybe fund closures as ETF popularity soars?
I don't think so. Only in that it's not bifurcated that everyone's going to passive. Which is not the case. We speak to a lot of advisors. That's just not the case. And there is a large preference for advisors. If you think that's where a lot of the space that from an asset management we talk to on institutions, but if you think about advisors, the bulk of the money is still on investment platforms, which means that you open the door to manage funds, and that hasn't changed at all. And the larger, if you think about where the spectrum of money is from an ETF in Australia versus managed funds, it is wholly in the managed fund camp. Again, been around for a lot longer. The second part of it is we don't have so the differences between a managed fund and Australian or ETF in terms of how it's looked at as a managed investment scheme are the same. They are identical. So that doesn't, again, change anything. Whether in the US, there's significant differences in terms of an ETF versus a mutual fund. So again, we don't have that tailwind that's really rocketed the ETF market. So I do not see at all that the managed funds. I think there is huge value in those. There is benefits to both. There's brokerage on ETFs. There's no brokerage on managed funds, but there's speed of execution on ETFs. You can get your money out in 2 days. Managed funds might take a bit longer. So we find many advisors have a preference for some in certain areas. Have a preference, if they want to get in and get out or have tactical positions, ETFs might work better. So it's not a either or. It's a both proposition for most investors, I would say.
Okay, last question. Some fundamental investors argue that passive investing is creating a bubble in markets. Do you agree with that, or do you completely disagree?
Completely disagree. In that, again, the size. Let's think about the three largest ETFs globally in the US are, from the three big players I mentioned earlier, all on the S&P 500. They're all over $500 billion US. And not seeing the data that has always been put out that they have moved the markets at any point. So, and they're already huge, right? So over $1.5 trillion US, they're already huge. So if it gets to a point where ETFs are taking up 50% of all the markets and then obviously just driving pure flows, well, there's a potential that has an impact. But it's not a bubble. A bubble is probably the wrong word for this. And really, if I was an active manager, I would look at this as a great opportunity in that this is your ability to say, well, we know what the passive players are going to do. That's insight. We should be able to benefit out of that. So certainly from a perspective of, and I'll go back to the quant points, like that, the rise of ETFs and the rise of passive has not impacted at all the ability to generate alpha. It has not seen us say, oh, geez, it's much harder now because the passive players are commanding so much money. So no, unequivocally don't believe it. There's a bunch of different arguments around that there's a very small door if everyone has to exit. But again, we've seen COVID. That was a really good test around ETFs, and they came through with flying colours. So no, it's I think it's certainly a myth. But again, 20 years time, maybe if ETFs are everyone all we got, which would be great, because again, I'm the ETF guy from a Macquarie perspective. That's wonderful, but I just don't see it happening.
Playing devil's advocate here, obviously you are the ETF guy. Is there anything that worries you about the direction of ETF markets?
We haven't seen it as much in Australia, but it is sort of starting coming a little bit. Again, there's benefits to this, but there's also, I think, probably significant drawbacks, is just the ability to probably have too much leverage in ETFs now, because I just don't think investors really understand it to the degree they probably should around how how they daily reset. So, for example, the US now, there's a really prolific market around single stock ETFs. And you think, well, why would anyone want a single stock ETF? Because it's built with ultra leveraged. So you're getting this like, you want to buy NVIDIA, for example, you can buy a 4 times leveraged ETF on NVIDIA. But if you held that for a long period of time, it's likely going to burn you because of these daily resets and the leverage. So, and look, that's pretty complicated. Like there's levels of complication there. So it's really incumbent on the managers to explain how that process works, explain the risks for investors. And what we're seeing come down the pipe now from ASIC is changing the naming conventions of funds and adding different styles. Like, for example, complex is going to come into place versus what used to be called synthetic. And that's good and bad. I think that sort of helps an investor go, okay, this says complex in the name. I need to do a little bit more work. But again, then it's incumbent on the ETF issuer to explain that and ensure clients understand what they're getting into. So I think there's this risk around gearing, where there's this the level of risk around non-geared products is obviously, you're getting it. You can look under the hood, which is great for most. Even some active managers now letting, for example, with these quant, you can look at what you've got on every single fund, which is a great benefit for ETFs. So it is something I'm a little bit more concerned about, is these super highly geared funds, because I just think someone's going to, and we've seen it happen. They've, again, the US blown up a few years ago with some inverse VIX leveraged ETFs. Like that's not the ethos of what ETFs is all about. So, but as you would expect, there is innovation, and people are thinking about different ways to package something around, into an ETF as best they can.
Okay, actual last question for today. We always ask our guests this question at the end of the podcast. If the market was to close for the next 5 years and you could only hold one ETF, what would it be and why?
I can assume you're not going to let me say my own.
No Macquarie ETFs.
Okay. I would probably go down the path of, and it's worked so well, the best bottom drawer ETFs ever has just been buying the SP 500. And put it away, close your eyes, come back in 20 years, and if you did that, obviously we can look backwards and go, that was the best trade. It was amazing, but just due to the ebbs and flows of the US market, it is the global capital. You have benefited of different regimes. You've benefited of the regime of when industrials were great. You've benefited now in the regime of technology being great. There is good parts to market cap weighted ETFs because the cream rises to the top. So no question, my bet. SP 500, low cost, solves a lot of problems for you.
Okay, well, thank you so much for your time today, Blair. It was awesome to have you here to talk all about ETFs and quant investing. Thank you again.
Thank you.